Hi, and welcome to Jankensgaard on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this episode, we're back on the research frontier. From the Frontier is the part of the channel where I bring recent research in corporate risk management and discuss some of the practical implications of this research. In this particular video, I'm going to discuss research that addresses the question of whether black swans are on the rise and how or what makes firms resilient to this type of extreme uncertainty. And for more on black swans and their corporate resilience, please consult my book, Empowered Enterprise Risk Management, co-authored with Petter Kapstad. There's also more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. All right, so the research on which this presentation draws is a working paper called The Black Swan Problem: The Role of Capital, Liquidity, and Operating Flexibility. And it's co-authored by yours truly, Nick Christie, and Nico Marinelli, and it's downloadable on SSRN. All right, before we get to the research findings, I would like to just briefly recap the concept of a black swan. According to Nassim Taleb, who wrote the book by that very name, a black swan has three attributes. The first is that it's high impact. We're talking massive consequences. The second is that it has a low probability, so that we struggle to see it coming and maybe we didn't think of it as possible even. Whereas after the fact, we're perfectly able to connect the dots and now it appears perfectly logical, and maybe we even fancy ourselves having been capable of predicting it. But that's with hindsight. So these are the three attributes of a black swan. It's very important to see also that black swans occur relative expectations, so that the information and knowledge that we have determine whether or not it's a black swan. So that the pandemic, for example, it was a black swan event to most people because they had not internalized the possibility, it was not part of their thought processes, they had not prepared for it in the least, whereas others had read a few history books and they were attuned to the whole idea because maybe they've even read up on research that pointed to this possibility, etc. So to them, it was much less of a black swan event. Here's an example of a black swan type event. Early 2020, it's the price of electricity in the state of Texas, which went through the roof after trading within a certain range for a long time. The tail just shifted in a big way. I mean, one of the implications of the black swan framework is that the tail can we're dealing with a moving tail, if you will. The tail is in flux. Maybe we're able to observe a certain range and we think that's about as far as it can go, but then it just shifts level completely. So that is what it can look like. But when we take the corporate perspective, as we do in this presentation, we have to ask, well, what does all this mean for companies? And all these civilizational level black swan events, they have to filter through lots of mechanisms and channels to ultimately affect firm performance. So not all firms have a meaningful exposure to some of these black swan events, right? So it comes down to shocks to corporate performance in the end. And one way to approach it practically, as we do in this research, is to look at the top line of corporate performance, which is revenue. And we define it then in terms of an unexpected year-on-year drop in revenue that is minus 30% or lower, meaning that the firm loses at least a third of its revenue over the course of 1 year. And true to the concept of a black swan, we have to somehow make sure it's an unexpected event. So how we do that is to exclude corporate events, corporate transactions like large asset sales, that could easily trigger a large drop in revenue, but we exclude that. We also make sure that there are 2 years of positive growth prior to the black swan event. So the revenue shock occurs on the back of two years of healthy growth, right? So that gives us reason to think it was unexpected. And here's an illustration of revenue shocks. We're comparing Norwegian, an airline, and Netflix. They were both growing rapidly for many years until the pandemic occurred, at which point Norwegian's revenue collapsed. Whereas Netflix was positively exposed to this Swan because as we were locked up and had plenty of time on our hands, we could watch more films. So growth continued. But what happened to Norwegian's revenue gives you an idea about these, what we're talking about here, revenue shocks. So the questions to be addressed, first of all, are Black Swans on the rise? This is often claimed, by management consultants or people in that line of business, and or just by looking at the media, you might get this impression that there's more uncertainty, more drama out there. So is it really true then that uncertainty is increasing over time? That's one of the questions we're going to look at. The other is what makes firms resilient to this sort of shock to the top line, or phrased differently, what helps firms survive and thrive even in worst case scenarios? So that's the meaning of resilience, basically, that we're able to continue to operate on our own terms. So how to do that then? Well, you can become resilient by adding buffers. These are shock absorbers that help you cope with wild uncertainty. So for example, by having a large cash balance or an equity buffer, those things help you deal with shocks. Inventory is another kind of buffer. Insurance is a conditional version of a buffer that, depending on the pre-agreed terms, it kicks in and gives you a payoff in when you most need it, presumably. So it's also a buffer. You can also invest in flexibility. That's another very general way of coping with uncertainty, right? So if you're able to exit an unattractive position, that's helpful because you avoid exposure you're able to cut your losses, basically. You can also make sure that you have a plan B so that when the shock occurs, you can shift your mode. You can make a change so that you're no longer exposed to this negative event to some extent, right? So the problem here is that managing tail risk by investing in buffers or flexibility is costly. It takes an investment up front. You have to commit resources and pay up here and now. And this is a problem because the benefits are somehow vague, right? They're distant and may occur in some distant future, and most likely they will not happen at all. So you're trading an upfront investment against some rather vague benefits in a distant future, right? So one way to look at it is that it reduces return on equity in the vast amount of or majority of scenarios in which nothing is going to happen. So in spite of that, you're going to have to make an effort to commit resources, which is difficult for most firms. For that reason, we want to know what is effective in out of these, different ways of coping with the tail risk, and that could inform our strategies, right? If we know what seems to work based on historical track record. And we're going to be interested in the concept of risk capital as we pursue this investigation. These are resources that help you survive and execute strategy in a worst case scenario. And the way it's been framed in the literature is in terms of equity capital that we're taking an interest in solvency and survival, whereas other types of risk capital deal more with liquidity. So you're now interested in whether or not you have a cash buffer to absorb cash flow shortfalls, meaning that your cash needs are greater than what you're able to generate through your operations. To sort of cover that kind of shortfall, you need some liquidity buffers around. So the focus is now on liquidity and strategy execution. Now, can you invest? Can you implement your business plan? That sort of thing. Operating flexibility is also going to be of interest to us because it's functionally equivalent. The more flexible you are, the less risk capital you need. right? If you can exit or implement a plan B, you know, that will cut your losses, and you don't need as many resources in the form of risk capital in that case, because you get out of the position, you don't need to cover the loss. All right, so we're looking at several testable hypotheses in the paper. First of all, are swans increasing over time? Then Taleb has this idea that large firms are more fragile. It may sound counterintuitive, but this is what he thinks. He argues that it's not an advantage to be large in times of distress. So we're thinking we should investigate that claim. And then these different buffers and flexibility then are making you more resilient. That's the thinking. The more cash you have, the larger your cash margins, you know, the profitability in the business, equity capital and operational flexibility, they all make you more resilient, presumably. So we define certain variables to be able to implement this test. And a black swan is a dummy variable, you know, ones and zeros. So it's 1 if revenue falls more than, you know, by a third. So negative shock to revenue between -30 and 90%. That's a black swan event. Then we use standard definitions of the other variables following the literature. We use a whole lot of data, everything that we could get our hands on, actually. I mean, the databases start in 1955, and we've downloaded all the series since then, you know, so it's very comprehensive. So we're posing this question then, starting out, you know, are swans getting more frequent over time, you know, and so we're looking at the proportion of firms that experience a swan in each year. And we're looking at whether that proportion is increasing or not. And it turns out that it is. There's a clear trend upward here, as you can see. The red line here is the black swan rate as defined. The blue one is a more extreme. We're even further out in the tail here. The definition is 50 to 90 here. But as you can see, the level is much lower in the first half of the sample compared to in more recent times. And also the spikes are getting more violent. I mean, the worst year on record was the financial crisis in 2009, where close to 15% of firms experienced the black swan as defined in this paper, and followed by the 2020 pandemic. So overall level has shifted up and the spikes are getting more intense, you know. So definitely the answer is yes to this question. Now you might say that, well, it's because more firms are in the tech industry, you know, that the kind of firm that's in the sample has changed, and that's certainly true. That's part of the picture. But we do see a similar increase in all the industries that are part of this study, including more traditional ones like manufacturing. So it's going on in across all industries. This slide here is meant to show that small firms are overrepresented among swan-afflicted firms. So the smallest third of firms account for 2/3 of all swans. So it's a clear overrepresentation among small firms. So we're ready to conclude then. Yeah, sure. The rate of black swans in the corporate sector is increasing over time. That's what the data suggests. And there's a clear overrepresentation among small firms. Now we're going to address the resilience question. And to understand what we're about to do, it's important to see that the way we frame resilience is in terms of how much a firm adjusts its workforce to one of these black swan events. And the idea is that the more you adjust, the more fragile you are, meaning less resilient. So if you're forced to make a large cut in your workforce in response to swan, that indicates weakness, it indicates fragility. So employment here now is our proxy for strategy execution. You might say that employees are our most valuable assets, as firms like to say. So it's clearly disruptive to strategy execution if you're forced to make drastic cuts to your business, right? And this has been shown by research that if you're making these drastic cuts, that damages long-term prospects, because you have to, you know, rebuild your workforce, and that costs money. You know, you have to first pay severance and then training costs, etc. So it's very inefficient. So you have good reasons to not make rushed and panicky cuts to your business, right? So that's the idea, and this is the model. We relate the number of employees then to a number of variables here, and this one dummy variable that we've defined. So the coefficient on this variable will tell us the extent to which firms are, on average, adjusting their workforce to a Black Swan event. And the answer is some 15, 16%, that's the average number. So if this kind of shock occurs to revenue, the typical response is to cut the workforce by, let's say, 16%. So indeed, massive consequences, right? We do not see an increase in fragility over time. I mean, we interact with a dummy variable that takes the value 1 after year 2000. It does not come out statistically significant, suggesting that corporate resilience is not different over time. Where this one rate is increasing, yes, but the resilience is more or less the same. In the next step, we add interaction terms. This is when we test the idea that these buffer variables work as shock absorbers. So cash margins, flexibility, equity ratio, and cash are all interacted with the Black Swan variable to see if they mitigate the blow. If they work as buffers, it should be a statistically significant reduction in the impact of a Black Swan. And here we're first able to see that the most swan-prone industry is the oil and gas industry, followed by business equipment. So a full 10% or almost 11% of firms in in the oil and gas industry experience Black Swans. So that's the industry distribution of swans. And here's the regression results when we look at small versus large firms. And small firms are not only seeing more Black Swan events, they're also more less resilient to them, contradicting the conjecture of Talon. So larger firms are more resilient. As for the buffer variables, we do find some support for the idea that cash margins are helpful in buffering against the tail risk events. The stars here are what to look for. That indicates statistical significance. The real sort of winner in this comparison between different buffer variables is cash buffers, though. So it's highly significant, suggesting that it's effective in buffering against tail risk outcomes. Operating flexibility and equity ratio, not so much. So they do not seem to have a crucial role in mitigating the impact of Black Swan events on corporate employment. And we do various drill downs and robustness checks, and the results all point to cash buffers being the most efficient way of or effective way of coping with tail risk. So we're ready for some more conclusions here now. Cash then is clearly, according to our results, more effective in absorbing tail risk. So whereas cash margins do seem to provide some of that buffering effect as well, whereas equity ratio, it's not doing that. So it's kind of a puzzle. I mean, other studies have shown that leverage does matter in times of crisis. So we should not rush to the conclusion that leverage is harmless. But in terms of mediating Black Swan type events, that hit the corporate top line, they do not seem to strongly mediate how that translates into shocks on corporate bottom lines in terms of revenue. Potential explanation is that lenders are propping up over-leveraged firms. This is a well-known phenomenon in certain countries, at least, where rather than seeing these firms default and disappear, they prefer to continue to lend them money just to avoid having to write down the loan, which would be harmful for their own purposes. So banks do that. So basically to protect the capital ratios, right? So they don't want to write down. So maybe instead, highly leveraged firms are cutting capital expenditure more aggressively because their banks don't have the same incentives. They are not shareholders and they care less about upside potential. So you might expect to see more cuts in capital expenditure. That's a possible line of interpretation. All right, summing up, Swan rates are increasing over time. Resilient firms maintain cost discipline in good times, and cash is most effective in creating resilience to tail risk. Those are the conclusions of this research. And thank you so much for listening.